Thank you for joining another episode of the Kansas City Commercial Real Estate Market Pulse, hosted by Logan Freeman, Midwest Commercial Real Estate Advisors based out of Kansas City, Missouri. Excited to be here with you live today on LinkedIn and on YouTube. So, if you have any questions as we're going through all of our data for today, we're calling this the pre feast to Thanksgiving. Happy Thanksgiving, by the way. Hopefully you're spending some time with your loved ones and going to take some time to reflect. But we're going to give you some things to reflect on today for sure. This is going to be a very, very deep dive into what we are seeing happen across the commercial real estate markets in Q3 and in 2025. And going to end up talking about how to advise and how to think through positioning if you're a commercial real estate investor, if you're an owner, if you're a business owner, what you should be thinking about here. And we're going to let the data really tell the story. So buckle up. This is going to be a lot of information. It's a solo episode today, episode 44 of the Kansas City Commercial Real Estate Market Pulse. But we are monitoring everything live. If you do have questions or would like to ask a question about something that we cover today, feel free to do so. So thanks for being here. I want to start by saying something that many of you, myself included, have been waiting to hear, and that is that the market has turned. For the past 3 years, we have navigated a landscape of unprecedented uncertainty. Unprecedented uncertainty. That's repricing, recalibrating, and frankly, a lot of wait and see. But based on our extensive data analysis, our proprietary models and on-the-ground insights from our network of top-tier operators, I can tell you with conviction that we've turned the corner. Q3 of 2025 wasn't just a good quarter. It was one of the strongest since 2019, signaling a definitive shift. And this isn't just anecdotal. The data confirms what smart investors and developers are already feeling. The recovery is not just a blip. It's real. It is real. Capital is actively flowing back into the market, and we are entering a fundamentally different phase. This moment is critical because the early movers, those who understand the nuances of this new environment, will be the ones who capture disproportionate value. So over the next 30, I don't know how long this is going to take me, 30 to 60 minutes, we're going to dive deep into what this market shift truly means. We're going to cover the key indicators confirming this recovery and why they're sustainable, where the capital is flowing, and which sectors are poised for significant growth. I'm going to give you some actionable strategies for navigating this new market cycle, whether you're looking to acquire, develop, or optimize your existing portfolio. We have completed at Midwest Commercial Real Estate Advisors over 119 different property performance audits, broker opinion of values, and underwriting experiments. I'll call it an experiment because sometimes it is. Underwriting experience for buyers in 2025. So our goal today is to cut through the noise, to provide you with clear, data-driven insights, and equip you to make informed decisions in a market that is finally moving forward. So let's go ahead and get started. This is where the rubber meets the road. These aren't just arbitrary numbers, right? They are unequivocal signals of a profound and fundamental market shift. What we're seeing is not merely a rebound, but a recalibration of value driven by persistent structural tailwinds that many, including myself, have been tracking closely for some time. Notice across the board gains here. Every sector is hitting post-COVID highs in pricing per square foot. This broad-based strength is critical because it indicates a robust and diversified demand, not just isolated pockets of activity, which we've been seeing previously. This validates our earlier thesis that underlying economic resilience, coupled with evolving demographic and technological trends, would eventually manifest in asset values. But let's dive into the standout performers, industrial and multifamilies. These sectors aren't just participating in the recovery, they are driving it significantly, outperforming the average for all property types since Q4 of 2019. Industrial with an astounding 81.6% climb, which is unbelievable, right? That reflects the enduring power of e-commerce and the reshoring and onshoring of supply chains, which has been fundamentally reshaping the logistics and distribution centers. Multifamily's 65.9% surge underscores the critical housing shortage and changing life living preferences, particularly in growth markets. This outperformance isn't accidental. It is a direct consequence of macroeconomic forces we've been monitoring, like inflation, population, migration, and evolving consumer behavior. For those who've been following our insights, these trends will come as no surprise. We've consistently highlighted these sectors as having the strongest long-term fundamentals, and the data now irrefutably confirms this analytical foresight. These figures are not just past performance, they are leading indicators for where capital will continue to flow and where strategic opportunities will crystallize. Understanding these nuances behind the numbers is paramount for positioning ourselves and yourself optimally in this new market cycle. Look at these numbers. Multifamily, $144 per square foot. Office, $135 per square foot. Retail, $134 per square foot. Industrial, $105 per square foot. Since Q4 of 2019, industrial prices have climbed 81%, and multifamily 65.9% compared to 56.2% across all those property types. This slide is talking about transaction velocity, which highlights a critical nuance often missed by superficial market analysis. So while everyone tracks transaction volume, or they should be, true market health, confidence, and momentum are best gauged by velocity, which is the sheer number of assets trading hands and at the pace at which these deals are closing. We're seeing a significant surge in transaction counts. It's up 12.6% quarter over quarter and 6.8% year over year for Q3 of 2025. This isn't just about big deals. It's about the broader market's willingness to transact. Over 45,000 commercial real estate properties traded hands in Q3 alone, which drove aggregate transaction volume up a remarkable 23.7% from Q2 and 25.1% from last year. The most compelling data point here, I think, which speaks volumes about the market sentiment, is the cumulative deal count. With over 93,000 deals through the first 3 quarters of 2025, we're now tracking between 2013 and 2015 levels. For those who recall, that period marked the sweet spot of the post-GFC recovery, a phase characterized by strong sustained growth and returning investor confidence. To be back in that range suggests a robust return to normalized market activity, possibly even signaling a new expansion cycle. This isn't just a recovery, it's the reacceleration towards a healthy liquid market. And this increased velocity directly correlates with market confidence and aggressive capital deployment. Institutional players in particular are highly sensitive to market signals. They don't move capital based on isolated events. They wait for clear patterns. They wait for liquidity to return and for pricing to stabilize before committing significant dry powder. And the data here indicates that those signals are strong and capital is no longer sitting on the sidelines. It's actively seeking deployment, driving competition and efficiency in the market. And so this phenomenon, the growing transaction velocity, is, in my view, the most underreported story in today's real estate narrative. While headlines might focus on interest rates or specific asset classes, the underlying pulse of the market, its transactional heartbeat, reveals a deeper, more profound shift. It tells us that despite ongoing macroeconomic uncertainties, the fundamentals are compelling enough to drive active investments and divestment decisions. So for us, this means that timing is becoming increasingly more critical. The window of opportunity to acquire assets at more favorable terms or to exit strategically is shifting. As this velocity continues to build, competition is going to intensify and market efficiencies improve. Understanding these dynamics allows us to position ourselves ahead of the curve, anticipating these marketing movements rather than merely just reacting to them. It's about reading between the lines and capitalizing on the undeniable momentum building beneath the surface. So 12.6% transaction counts. Q3 2025 surged on the transaction counts. 45,000 properties changed hand. Aggregate transaction volume of $150 billion. Cumulatively, this year, 93,000 deals have closed. That's $265 billion of total volume through Q3 of 2025, which has surpassed both 2023 and 2024 for the same period. Let's go into some subsector performance here, right? So this takes us behind the macro level statistics and into the granular detail of subsector performance, which is where we truly identify where the smart money is moving. While overall market stability is crucial, it's in these subsector trends that uncover alpha opportunities and understand fundamental shifts in consumer and business behavior. We saw an impressive 13 out of 15 subsector record quarterly price increases in Q3. So let's dive into some of these surprise winners here and the underlying drivers. So storage up 7.6% quarter over quarter. And this isn't just about people hoarding possessions. It reflects deeper demographic shifts like downsizing, urban migration, and the booming e-commerce sector driving demand for last mile logistics and flexible inventory solutions. It's a consistently resilient asset class that continues to impress. Small bay industrial, same tailwinds. Automotive retail is up 5% quarter over quarter and is up 19.4% year over year. This isn't just solely about car dealerships. It encompasses repair facilities, service centers, and even emerging EV charging infrastructure. So despite predictions of ride-sharing dominance, personal vehicle ownership remains strong, and the transition to electric vehicles creates new demand for specialized real estate for maintenance and for charging. Medical office is up 5.1% quarter over quarter or 14.4% year over year. An aging population, advancements in outpatient care, and its inherently recession-resistant nature continue to make medical office properties a standout performer. Healthcare's demand is inelastic, ensuring steady occupancy and rental growth. Our call-out box here highlights a critical insight in hospitality. While the sector as a whole had slower annual growth, full-service hotels significantly outperformed limited service. This isn't just a blip, it's a clear indicator of post-pandemic shift towards experiential higher-end travel and the resurgence of business travel. Consumers are willing to pay for a premium for quality experiences, suggesting a strategic pivot for those invested in the hospitality sectors. So I want to look at some of the decliners as well here, and more importantly, understand whether these are kind of cyclical or structural challenges. So bars and restaurants were down 2.5% quarter over quarter. And we view this largely as a structural issue rather than a purely cyclical one. The rise of delivery services, ghost kitchens, and evolving consumer dining habits are fundamentally reshaping the restaurant landscape. High operating costs and razor-thin margins in the traditional models are making profitability challenging, even as people return to social activities. Big box retail down 2.8% quarter over quarter. And this is another structural challenge, primarily driven by the relentless growth of e-commerce. While certain big box segments like grocery stores or discount retailers can adapt, the broader category faces ongoing pressure to reinvent or to consolidate, which we have seen. So our ability to identify these nuanced subsector trends allows us to spot these alpha opportunities before they become mainstream, right? It's about understanding how broader consumer preferences, technological advancements, and demographic shifts translate into specific real estate demands, which enables us to position ourselves strategically in a dynamic market. Thought this was really interesting. This geographic divergence, the Los Angeles anomaly, right? This is truly astounding and frankly shocking development. The geographic divergence in real estate performance, specifically hiding the Los Angeles area, for decades, LA has been considered a bedrock of real estate value, a seemingly invincible coastal market. Yet in Q3 of 2025, Los Angeles stands alone as the only major metro to post price declines across all sectors. This is not just a minor blip. It's a profound signal When we see office space plummeting by over 27%, retail by over 21%, and even industrial and multifamily dipping into the negative territory, it forces us to ask what's really behind this and what's happening on the ground in LA. While the underlying factors here are a confluence of specific local policy decisions, significant outmigration patterns driven by affordability and quality of life concerns, and evolving economic principles that are less favorable for traditional industries and more susceptible to remote work impacts. So let's contrast that with Miami. While LA is struggling across the board, Miami's office market surged by an incredible 32.7% in Q3, and that's the largest gain among the top MSAs. This isn't just accidental. Miami has strategically positioned itself as a business-friendly hub, attracting significant capital and talent, especially from higher tax states. It signals a shift in where business and wealth want to be located, driven by a combination of favorable tax policies, strong in-migration of high-income earners, and a resilient, diversified economy. The divergence isn't just limited to these two cities. It reflects a broader bifurcation happening within what we traditionally call coastal gateway cities. Some, like Miami, are adapting and thriving, while others, like LA, are facing serious structural headwinds that are impacting every facet of their real estate market. So the days of assuming of a rising tide lifts all boats in major coastal markets are over. As sophisticated investors and owners, understanding these nuanced local market dynamics and their profound impact of policy is absolutely critical. Blanket assumptions based on historical performance are dangerous. Our ability to dissect these local factors and predict how migration, policy shifts, and evolving economic bases translate into real estate performance is paramount for making astute investment decisions in this rapidly changing landscape. So here's the bottom line, right? We've just seen a stark picture of market divergence from the Los Angeles anomaly to the soaring performance in other metros. That wasn't just data. It's a snapshot of a market in rapid motion demanding our attention. As the title of this slide says, waiting for clarity is no longer an option. The opportunity isn't static. It's evolving right between and right before our eyes. This isn't time for just passive observation, but proactive insight. Now, to truly understand what this rapid movement means for us and how we can best position ourselves, we need to go beyond the numbers. And so I've distilled these complex trends into three critical shifts that are fundamentally reshaping the real estate landscape. These shifts are not just observations, they are actionable insights that are going to guide your strategy forward. So let's dive in and unpack what these mean for your investment decisions. Well, what's changed, right? Here's the three critical shifts. We've just dissected the immediate data, uncovering some patterns and anomalies, but raw data, while essential, is only the starting point. To truly navigate this evolving landscape, we need to move beyond the symptoms and understand the underlying forces at play. So I want to pull back the curtain and reveal what's truly driving the current market dynamics. While many might focus on traditional indicators, my analysis suggests that three specific critical shifts are fundamentally reshaping opportunities and challenges across the board. And these aren't just minor fluctuations. These are tectonic shifts that will dictate market performance and investment viability for the foreseeable future. Understanding these isn't just an advantage, it's essential for anyone serious about future-proofing your strategy. And they transcend regional variations and seasonal trends, impacting the very structure of the commercial real estate market. And I spent considerable time distilling these three complex influences into actionable insights. And these are key drivers that, in my view, matter most right now. We're not just going to talk about what happened, we're going to explore why it happened, and more importantly, what it means for what's coming next. So let's dive into the first one of these critical shifts. Kicking it off with arguably the most significant shift that we're witnessing, the powerful return of institutional capital. This isn't just a trickle, it's a flood. After a period of measured caution, the big players are back at the table, and they're deploying with assertiveness that we have not seen in a while. This fundamental shift underpins virtually everything else happening in the market. And when I say institutional investors, I'm talking about the giants, the Blackstone, Starwood Property Trust, RCG Ventures of the world, right? I've had conversations with folks at these firms, and the message is clear. They've identified pockets of opportunity, and they're moving decisively. Their Q3 activity leading the charge of refinancing, repositioning, and value add plays is a testament to this renewed confidence and strategic focus. So what does aggressive deployment actually mean in this context? It means they've moved beyond purely defensive strategies. They're not just preserving capital, they're actively seeking to grow it. And this translates to quicker decision-making, larger fund allocations, and a willingness to engage in more complex transactions to achieve their target returns. It's about seizing the market share and leveraging their considerable financial power. So this renewed institutional activity is directly connected to broader capital market conditions, right? The perceived stabilization of interest rates coupled with robust corporate earnings and moderating inflation has definitely provided the certainty that these large funds need to re-enter the market at scale. They're seeking attractive risk-adjusted returns in specific asset classes and geographic locations, driving this accelerated deployment. And so from an institutional investment strategy perspective, these firms are meticulously evaluating their portfolios. They're identifying assets ripe for repositioning, and they're actively seeking opportunities to add value through strategic upgrades and operational efficiencies. Their focus on refinancing also indicates a belief that the current lending conditions are favorable and that they want to lock in advantageous terms while they can. They're playing the long game, but with a sharpened short-term execution focus. So understand this: the availability and flow of institutional capital acts as the ultimate liquidity engine for our markets. Its return, particularly with this level of aggression, serves as the foundational bedrock for asset valuations, for transaction volumes, and overall market stability. If you're wondering why things feel different, this is where it starts. So building on our last point about the aggressive return of capital, the next major indicator of market health is pricing. And the message is clear. Pricing has not only stabilized, but we are now seeing consistent, measurable increases all across all major asset classes. And the significance of that early 2024 bottom cannot be overstated. That wasn't just a temporary pause. It was a true inflection point. Savvy investors who understood the market cycles recognized that moment, that the signal that the correction phase was largely over. And we'd experienced the necessary repricing and the market found its equilibrium. So now, stabilized and rising isn't just about numbers, it's about psychology. It means the fear and uncertainty that often accompanies a downturn has dissipated. Investors are no longer waiting for the next shoe to drop. Instead, they're seeing a compelling value and acting on it, driving prices upward. This shift from wait and see to act now is a powerful psychological accelerant for the commercial real estate market. And this upward price movement is a direct reflection of capital confidence that we discussed. When institutional money returns aggressively, it doesn't just sit on the sidelines. It seeks deployment, and that demand naturally pushes prices higher. Well, what we're seeing is a healthy feedback loop. Confident capital drives pricing stability and growth, which in turn fuels more capital confidence. And for those of us who track market cycles closely, this current phase is entirely consistent with a predictable recovery trajectory. We've moved from price discovery through stabilization and now firmly in the growth phase. This isn't speculative froth. It's fundamental re-rating driven by strong underlying demand and improving economic sentiment. So ultimately, this validates the recovery thesis many of us have had. The market proved its resilience, absorbed the shocks, and is now rewarding those who maintain a long-term perspective. This isn't just a bounce. It's the beginning of a sustained upward trend. What does this mean for you? I mean, if you're a seller, you're now operating in a far more advantageous market. Buyers are motivated and willing to pay for quality. For buyers, while the deep discounts are gone, you're acquiring assets in a rising market, which often offers significant opportunities for value appreciation. This cycle continues to unfold. Okay, so moving on. This is the slide that everyone needs to pay close attention to. Cap rates are set to compress in 2026. If you're looking for the single biggest indicator of future value appreciation, it's right here. Cap rate compression isn't just a technical financial term. It's the mechanism through which we see a fundamental re-rating of asset values. And it's shaping up to be the most significant shift we'll witness in the next 18 to 24 months. We've all been watching the multifamily sector closely. And for the past 7 quarters, cap rates have flatlined at 5.7%. To put that in perspective, that's the longest plateau that we've seen in a quarter century. This stagnation has created a significant disconnect. While property values were stabilizing and even starting to climb in other sectors, multifamily had been waiting for this shoe to drop. This prolonged stability has actually coiled the spring for what's coming next. So our detailed analysis, leveraging First American's data, reveals a compelling story. There's a 60 basis point gap between the current cap rate of 5.7% and where the underlying market fundamentals suggest it should be, which is closer to 5.1%. This isn't just a theoretical number. This is a direct reflection of improving property performance, strong renter demand, and a recalibration of risk premiums that hasn't yet been priced into the current asset valuations. When that gap closes, it directly translates into significant value appreciation for the asset holders, right? So the mechanics are straightforward. The lower the cap rate mean higher property values for the same net operating income. As capital reflows into the market aggressively, and as the underlying economics of multifamily assets continue to strengthen, investors will increasingly accept lower initial yields for the stability and growth prospects that these assets offer. This increased demand for assets at a lower cap rate will drive prices upward, allowing that unrealized value to be unlocked. And why 2026? We see 3 critical forces converging. First, the overhang of distressed assets is finally clearing. It's bringing much needed transaction volume back to the market. Second, credit conditions are easing. Banks have recapitalized and are showing renewed appetite for lending, which fuels investor capacity. And crucially, renter demand remains incredibly robust, with household formations up 2.7% year over year, ensuring the stability of income streams. These aren't speculative trends. They are the fundamental shifts, creating the perfect storm for cap rate compression. So for those of you holding quality multifamily assets, right now you're sitting on an impending wave of value appreciation. So the window for acquiring these assets at a relatively higher cap rate is closing rapidly. Understanding and anticipating this compression is the key to strategic portfolio management and maximizing returns in this cycle. This isn't a forecast of a potential event. It's an analysis of an almost inevitable market movement driven by powerful economic forces. Okay, so we have established the macro forces at play with cap rate compression. I'm going to dive into the specifics of where we're seeing the most compelling opportunities and, frankly, the undeniable leadership in today's market. This isn't just about trends. It's about dissecting the performance and understanding the underlying mechanics of each property type. So starting with multifamily, the data unequivocally paints it as the clear winner. For the 6th consecutive year, multifamily has outpaced all other property types, delivering a robust 5.48% return in Q3 alone, right? So what's driving this sustained outperformance? Well, it comes down to a confluence of powerful factors, right? First, construction starts continue to be muted. So while demand remains strong, new supply has been constrained, exacerbating an already long-standing housing shortage, right? Second, we're confidently saying that peak vacancy is behind us. The market has absorbed recent supply and occupancy rates are firming up. And third, rent growth is stabilizing, moving from the explosive, unsustainable highs of recent years to a more predictable, healthy trajectory. And this provides confidence for long-term underwriting and capital preservation. So finally, critically institutional capital views multifamily as the safest bet in uncertain times. An environment marked by economic volatility, geopolitical shifts and interest rate flux, the stability of cash flows, the inelastic demand for housing, and the proven track record of capital preservation make multifamily an unparalleled safe haven for large-scale investment. Investors are chasing these stable, risk-adjusted returns, and multifamily is consistently delivering. Moving on from multifamily, let's turn our attention to the industrial sector, which continues to demonstrate remarkable structural strength. Even as we observe some moderation in rent growth and approach that might consider peak vacancy in certain markets, the underlying fundamentals are extremely robust. This sector posed an impressive 4.9% price growth in Q3 and constituted a significant 13% of all listings, underscoring its continued relevance and investor appeal. So what are the core drivers sustaining this strength? Well, firstly, a substantial 75% of logistics demand is directly tied to population centers. primarily driven by domestic consumption, right? This highlights the indispensable role that industrial plays in getting goods to consumers. Regardless of global trade dynamics, local populations need to be served, making these facilities critical infrastructure for the everyday economy. Secondly, while the explosive growth seen during the pandemic era has normalized, e-commerce continues to be a powerful engine for absorption. The structural shift towards online shopping is permanent, constantly demanding more sophisticated fulfillment centers, last mile hubs, and return processing facilities. And this isn't just about more boxes, it's about the speed and efficiency, requiring well located, technologically advanced industrial space. Thirdly, new development faces significant limitations. Escalating construction costs, particularly for materials and skilled labor, coupled with rising interest rates, make new projects challenging to pencil out. A less obvious but increasingly critical constraint is power availability. Many high demand industrial uses like cold storage facilities and advanced manufacturing, they're energy intensive. So finding sites with adequate and expandable power infrastructure is becoming a major bottleneck for new supply. And then finally, we're seeing intense demand from data centers. These are essentially industrial users requiring vast tracts of land and immense power capabilities. And the rapid expansion of artificial intelligence, cloud computing, and big data analytics is pushing hyperscale data center development into established industrial corridors, creating these intense competition for land and power resources and further exacerbating scarcity in key markets. So for a reality check regarding reshoring, right, while the strategic imperative for businesses to bring production closer to home is undeniable, the large-scale exodus from overseas manufacturing hasn't materialized as broadly as some had hoped. This is primarily due to persistent labor shortages in skilled manufacturing, the high cost of domestic production compared to overseas, and existing infrastructure limitations. However, the steady demand for goods alongside some targeted nearshoring efforts provides a consistent, healthy baseline for the industrial sector, preventing any significant downturn. So from an investment perspective, the play remains clear. Strategic locations that offer immediate access to population centers and facilitate efficient last mile delivery are going to continue to command premium pricing and strong tenant demand. But a new critical factor has emerged: power availability. As mentioned, for many of the modern industrial users, reliable and expandable power is non-negotiable. Therefore, properties that offer that robust power infrastructure are no longer just desirable, they represent a new scarcity premium, offering a significant competitive advantage in today's market. Understanding these nuanced drivers is key to identifying the value and resilience within the industrial real estate market. All right, retail. Retail is delivering. Let's shift our focus over to the sector that gets a bad rap, but's proved to be truly a quiet outperformer. Many investors scarred by past headlines of the retail apocalypse tend to overlook the fundamental strength that's currently driving this market. But if you look past the noise, the numbers tell a very different story. We're seeing remarkable momentum here. The sector experienced an impressive 47% growth in listings year over year. This isn't just a statistical blip, it's a strong signal of renewed investor interest and increased market activity. It indicates a healthier, more dynamic market where properties trading hands and capital is flowing back into the sector. Moreover, retail has posted its 17th consecutive monthly price gain, clearly demonstrating sustained demand and pricing power. And critically, vacancy rates remain at near historic lows, underscoring a very tight supply-demand dynamic. So what are the key drivers behind this resurgence? Well, first, and perhaps most importantly, is the record low development pipeline. Second is we're seeing incredible tenant diversification. Gone are the days when retail centers were solely relying on traditional soft goods. Today, the tenant mix is far more resilient. We're seeing a significant influx of restaurants, fitness centers, medical and health-related services, and a wide variety of experiential uses like entertainment venues and boutique services. And these businesses are largely e-commerce proof and provide consumers with reasons to physically visit those centers, boosting that foot traffic and stability for landlords. And third, we've got healthy rent growth. It continues, and it's albeit with some moderation. It's not the explosive growth we might see in other sectors at certain times, but the consistent upward trajectory in rents reflects strong tenant demand and landlords' ability to command higher prices for well-located, productive space. And finally, consumer spending is holding up better than many anticipated. Despite economic headwinds, while consumer spending is holding up, better than many anticipated despite those economic headwinds. While there are certain areas of concern, overall consumer resilience, supported by factors like a strong labor market and accumulated savings, continues to fuel retail activity. People are still going out, dining, exercising, and seeking experiences, which directly benefits physical retail. I'd like to address the caution, right? There are indeed wild cards like tariff uncertainty and the potential for slowing consumer momentum heading into 2026. These are factors we need to monitor as they definitely could impact the sentiment and spending habits. However, it's crucial to understand that retail's strong supply-demand fundamentals provide a significant buffer against these potential headwinds. The scarcity of quality space and the diversified tenant base make this sector far more robust than it might appear on the surface. So for investors, the play is clear here. Focus on well-located neighborhood centers and community centers. These are the lifeblood of local communities, providing essential services and daily conveniences. Let's go over to everybody's favorite asset class right now, office. And the comeback is becoming real. It's a space that's been heavily scrutinized and often written off, but where we're finally seeing the early signs of a significant turnaround. Many have declared the office dead, right? But the data is starting to tell a more nuanced story. The headline here is critical. For the first time in over 5 years, office posted an annual vacancy decline. This isn't just a minor fluctuation, it's a profound inflection point. After years of increasing vacancies driven by remote work and economic uncertainty, a 20 basis point drop to 18.8% in Q3 signals that the market is stabilizing and beginning to absorb space again. This vacancy decline is the foundational indicator that the worst of the downturn is likely behind us. Coupled with this, we're seeing meaningful pricing gains. Prices for CBD office properties rose 4.6% year over year, and suburban offices saw a 4.2% increase. What's even more encouraging is the annualized monthly momentum, which suggests that these gains are accelerating. So it's not just a dead cat bounce. It indicates genuine investor interest and a willingness to commit capital to the right assets by improving outlook for rents and occupancy. What we're observing are the early yet undeniable stages and signs of a longer-term recovery in the office sector. It's not uniform, as our nuanced points highlight, but there are still significant headwinds for older commodity products, especially in some CBD markets. But for discerning investors who understand the new fundamentals, focusing on suburban Class A and amenity-rich properties and strong employment hubs, that's the opportunity to enter into this cycle, and it's now emerging. The markdown cycle appears to be ending, and we're entering into a phase where selective investment will yield significant returns as office continues its evolution. Moving from the comeback in office, let's pivot to the land sector, which is presenting a surprising and significant story. To see land listings surge by a remarkable 69% year over year is highly indicative of, especially considering that land deals often precede other real estate activities and generally slower to react to market shifts. This isn't just an anomaly. It's a strong signal about the underlying health and future direction of the market, placing it as its fourth most active sector in Q3, just behind industrial. So it's not just random. It's driven by very specific, powerful demand drivers. So first, we've got housing development needs encompassing both single-family homes and multifamily projects. Second, and perhaps the most dynamic, is the explosion in demand for data centers. The insatiable growth of AI, cloud computing, and digital infrastructure requires massive amounts of processing power, which translates directly into a critical need for substantial power availability. This is now the primary factor driving site selection, which is creating intense competition for land in submarkets. And third, the industrial logistics continues its strong trajectory. The ongoing expansion of e-commerce and strategic emphasis on supply chain resilience means that companies are still building out their last mile delivery networks and larger distribution hubs. So what we're seeing here is a powerful connection between current land acquisitions and broader development and investment trends. Land is the foundational asset. Securing it is the first tangible step toward any future physical development. This aggressive land banking signals a long-term confidence in the specific market segments and future economic growth, despite immediate macroeconomic concerns. This makes land a critical leading indicator. So unlike existing properties, which reflect current market conditions, land transactions are forward-looking. They tell us what developers and investors anticipate will be profitable 2, 3, or even 5 years down the line. Therefore, the robust performance in land is now crucial. It ensures a healthy pipeline for future developments and those cycles across these high growth sectors. In essence, this surge in land activity is an early powerful sign of confidence in future development. Despite the current constraints like rising construction costs and tighter financing and tariff uncertainties that are slowing down immediate project starts, buyers are not hesitating to acquire land now. They are strategically positioning themselves for development timelines extending into 2026 and 27, demonstrating a clear belief in sustained demand and returns down the road. This activity speaks volumes about where smart money sees future opportunities. We've got some top performers in regards to geographic winners and losers. You guys can read the full report and take a look at what we've got going on in regards to the geographic side of things. But what I did want to show is that the financing picture, this is a big update. Banks are back, right? This is huge. And it captures a seismic shift in the commercial real estate landscape, the re-engagement of traditional bank financing. When we say banks are back, it's not hyperbole. It's a profound indicator of renewed market health and confidence. And it's truly huge for the market. Think about it. I mean, bank lending is the lifeblood of commercial real estate. It's what lubricates transactions, enables new development, and facilitates value creation. So without robust bank participation, the market operates under severe constraints, relying more on more expensive or less traditional capital sources. The return of banks signals a fundamental thawing of credit markets, moving past the tighter conditions we've experienced over the past few years. And the numbers speak volumes. A rise in commercial real estate lending volumes of 18% in Q3 isn't just a statistical blip. It marks the 5th consecutive quarter of growth. And this sustained trajectory signals a meaningful shift in lenders' risk appetite and their perception of market stability. Furthermore, the Mortgage Bankers Association's report of a 36% year-over-year increase in commercial and multifamily originations underscores this robust return. So that's not just marginal activity, it's significant broad-based reentry. And this re-engagement directly translates into increased market confidence and liquidity. When banks are lending, it means they've assessed the risk-reward equation and found it favorable. This perception filters through the entire market, encouraging more investment, more development, and ultimately more robust activity. It provides crucial liquidity, allowing properties to transact and developers to initiate projects that might have been on hold. So for those of us that are tracking credit cycles, this is a clear sign that we're moving past the contraction phase that followed interest rate hikes and the broader economic uncertainty. The tightening of credit standards was a significant headwind, and that stifled deal flow and exacerbated valuation challenges. The current trend suggests a normalization or even an expansion of credit availability, which is a critical ingredient for commercial real estate's sustained recovery and growth. So what does this mean for borrowers and the broader market? For borrowers, it's simpler to access capital, potentially at more competitive terms. And this can reduce overall project costs and improve investment returns. And for the market at large, it means that a more active transaction environment, improved clarity on asset valuations, and a pathway for developers to meet the ongoing demand for various property types. This is not just a return to business as usual. It's a recalibration and a renewed opportunity to leverage traditional finance in strategic ways. So we just covered a lot in the commercial real estate on the tailwind side of things and the renewed confidence in the commercial real estate market. It's equally crucial to provide a balanced and realistic perspective, right? The credible analysis isn't just about highlighting opportunities. It's about openly acknowledging and understanding the challenges that still exist. These aren't necessarily insurmountable obstacles, but rather factors we need to navigate strategically. First, we've got macroeconomic certainty. While we've seen some positive economic indicators, several aspects continue to cast a shadow. Corporate layoffs, though perhaps not as widespread as earlier, are still occurring in certain sectors, which can impact consumer confidence and retail and office demand. So job creation is indeed slowing, which is a natural progression from post-pandemic surges, but also suggests a cooling labor market, potentially affecting household income and spending. Next, let's look at transaction volume still below peaks. While we noted a surge in activity, it's important to frame this correctly. Q3 transaction volume, despite its improvement, was still 22% below prior year levels. So what does that tell us? It suggests that while the market is certainly more active than it was during the deepest troughs, it's not back to the frothy levels that we saw during peak periods. Then we have the enduring challenges of the office sector. Despite some improvements, the fundamentals for office properties are still years away from reaching pre-pandemic norms. And then finally, the cap rate plateau in multifamily is a key indicator of continued buyer caution. Right? Multifamily cap rates have remained stubbornly stuck at 5.7% for 7 quarters. So these headwinds mean, in the context that we just talked about, they highlight the fact that while the commercial real estate market is certainly improving and presenting compelling opportunities, it's not without its complexities. And these challenges underscore the need for sophisticated analysis, selective investment, and agile strategies. So let's talk about those next. Okay. So let's go to the strategic takeaways for commercial real estate owners. First, and perhaps most importantly, value appreciation is coming in 2026. Our research indicate a significant cap rate compression on the horizon, coupled with sustained price increases. This leads us to our second point. Your assets are appreciating faster than you think. While recent adjustments have been swift, the data shows that median pricing has already hit post-COVID highs across all sectors. This upward trend often outpaces conventional owner perceptions, especially for those who haven't recently had their assets rigorously appraised. Third, now is the time to refinance. For many, this window is opening wider. We're seeing banks re-engage with commercial real estate lending more aggressively. Rates have settled into a more favorable range, and terms are becoming more attractive. Fourth, if you're considering selling, the conditions are right. Buyer appetite is currently at multi-year highs. The bid-ask spread, which has been a persistent challenge, has notably narrowed. This means that buyers and sellers are finding common ground more easily, leading to smoother and more efficient transactions. If you have assets that you've been looking to divest, this could be an optimal window to achieve your desired valuation with less friction. Fifth, your deal size matters. We're observing a clear trend where larger assets, specifically 50-plus unit multifamily properties and 20,000-plus square foot office and retail spaces, are commanding institutional premiums. And that capital is actively seeking scale, and they're willing to pay for it. 6, the subsector positioning is critical. The market isn't a monolith. We're seeing medical office, self-storage, and automotive retail subsectors significantly outperform. Conversely, traditional big box retail and certain segments of bars and restaurants continue to face headwinds. So finally, quality matters more than ever. The flight to quality is a dominant theme. Well-maintained, well-located assets with strong underlying fundamentals are commanding significant premiums. This isn't just about Class A, it's about properties that have been strategically managed, they offer modern amenities, and they provide clear value propositions. Investors are discerning, and they're willing to pay for certainty and performance. So if your assets meet this criteria, they're highly sought after. If they don't, proactive investment in upgrades or repositioning might be vital. These moves, and these aren't just observations, they are immediate opportunities and critical considerations for your next move. As your trusted advisor, I'm here to help you navigate these strategic decisions, turning analysis into tangible success for your portfolio. So let's definitely talk about those takeaways. So for commercial real estate investors, right? Conversely, these are critical. It's a critical juncture for capital allocation, right? The deep discount window is closing. You got to buy before the cap rates compress, right? Our projections for 2026 indicate a significant compression. Secondary markets are at play, right? Our data consistently shows that non-major metros outperforming gateway cities by a remarkable 600 basis points. Multifamily and industrial continue to lead. However, I urge you to watch retail very closely. Deal velocity is equaling competition right now. The Q3 transaction volume of 45,000 deals is a clear indicator that the market is active and competitive, right? So let's move on to business owners. Business owners, lease rates are stabilizing. That's good news for office tenants. Industrial space remains tight. You got to plan ahead for your expansions. Retail rents are rising. Strong retail fundamentals mean landlords have pricing power. Finance is easier right now. So if you consider owner-occupied properties, banks are lending again. And then larger facilities are costing more. Medical and healthcare tenants are winning, and storage demand is spiking. So if you're a business owner, those are things to keep in mind. Friends, colleagues, we've covered a lot today, from granular market shifts to strategic opportunities. But if you take one thing away from this presentation, today's episode, let it be this: the window is now. We're standing at a critical juncture in the commercial real estate market. The data points, as you've seen, are unambiguous. Prices are indeed rising across all major sectors, reflecting renewed investor confidence. Transaction volume is surging, indicating capital is actively being deployed. And yes, banks are lending again, albeit strategically, providing the liquidity necessary for deals to close. These aren't just isolated trends, these are synchronized signals pointing to a powerful market recovery. We're seeing cap rates set to compress in 2026. Institutional capital is deploying at scale, often ahead of the broader market. This is the definition of an inflection point. I've spent my commercial real estate career analyzing these shifts. I can tell you with conviction the best opportunities are always found at these inflection points. It's when the market has undeniably turned, but not everyone has fully grasped its implications yet. That is precisely where we find ourselves today. So waiting for perfect clarity is a luxury many cannot afford. The market rarely offers a clearer signal than what we're seeing today. Those who hesitate risk missing out on optimal entry points, favorable financing terms, and the chance to truly amplify their returns in the upcoming cycle. While Q4 2025 might see some typical year-end quietness due to seasonal patterns and positioning, make no mistake, smart operators are not waiting. They're using this precise moment to refine their strategies, solidify their partnerships, and prepare for what promises to be a profoundly strong 2026. So I'd like to leave you with 3 critical questions for reflection. Are you strategically positioned to capitalize on the impending cap rate compression in 2026? If you're holding quality assets, have you proactively explored refinancing to lock in more favorable terms that are now available? And if acquisition is on your radar, are you moving decisively before competition intensifies it further and prices continue to climb higher? As the market is in motion and it's moving fast, the real question for all of us is, are you moving with it or are you observing it from the sidelines? This isn't just about understanding the market. It's about acting on it. The next 12 months are not just another period. They're the defining window for positioning your portfolio for the next cycle of growth and prosperity. Don't let this moment pass you by. We are now working on over $100 million of commercial real estate in Kansas City, and we are poised to have a breakout and incredible year in 2026. If you would like to have your property, go through a property performance audit, benchmark against other properties. If you're looking to buy a property, owner occupant, you're looking to lease space, Midwest Commercial Real Estate Advisors can support you. If you want to talk through anything that we discussed here today, feel free to reach out. I hope you guys have a wonderful Thanksgiving. Do watch the newsletter on LinkedIn tomorrow because this full report will be going out to everyone in that newsletter. This was episode 44 of the Kansas City Commercial Real Estate Market Pulse, and I'm Logan Freeman, Mr. Kansas City, and I'm here to help you navigate all of these complexities and turn these insights into your competitive advantage. Thanks for being here today. Thanks for tuning in. See you next time.